Hi everyone. My name is Bagus Suryo Setiawardono, and as you guys probably already know, I am the teaching assistant for our auditing class that is taught by Mrs. Arizona and Mrs. Devi Farmawati. And in today's opportunity, I would like to create a video that talked about the previous two quizzes that you guys have already worked on in detail, and I hope that this video will provide you with more insight and understanding and make you have better preparation for the upcoming midterm exam. Now, of course, in this video, I will be talking about the previous two quizzes that you guys have already worked on, but not only that, I will be talking about the topics that those two quizzes were based on. So, if you recall, the first quiz was based on the topic of management assertions, and the second quiz was based on the topic of audit evidence. So, let's get into it. For the first topic, we will be talking about management assertions. So, our prescribed textbook have defined management assertion as implied or expressed representations by management about classes of transactions and the related accounts and disclosures in the financial statements. And in most cases, they are implied and not explicitly stated. Now, what does implied mean? Let's take an example. As you guys can see in the slide, I have provided a screenshot of Astra International's balance sheet, and you can see that they wrote in their balance sheet that their cash and cash equivalent amounting to 61 trillion rupiah in 2022. Based on this record in the balance sheet or in the financial statement in general, the management of Astra International assert that they have cash present amounting to 61 trillion rupiah that are unrestricted and available to use for their normal operation. Of course, they did not say outright that, oh, we have 61 trillion of money to spend. Like they did not say that explicitly, but they said that they have 61 trillion of money that are ready to spend when they write this number in their balance sheet. It is an implied expression written by the management and not an explicit statement. Management assertions are divided into two broad categories, and they are assertions about classes of transactions and events, and assertions about account balances. I understand that it might be slightly difficult for you guys to differentiate between the two, but in my experience, I usually make a distinction for both of them like this. For assertions about classes of transactions, they are very related to the inherent transactions that have effects on financial statements. For example, like a sale transaction. Whether or not a sale transaction has been recorded by the management is considered as an assertion about classes of transaction and event. On the other hand, assertions about account balances are related to the items or accounts themselves and the respective balances. For example, like I just mentioned earlier, Astra has 61 trillion rupiah available for use. Now, for each assertion, I'm not going to go into detail here because I believe that the book have already explained about them in detail. So I think it might not very effective for me to re-explain it, but in the worst way. I suggest that you just read the book for better understanding. So to better understand about the difference between assertions about classes of transactions and events and assertions about account balances, we can see in the first assertion for each of them. For the assertion about classes of transactions and event, we can see that the first assertion is occurrence. It is about whether or not transactions and events that have been recorded or disclosed have occurred and pertain to the entity. So this is more about whether or not the event or transaction have actually happened or occurred. As you guys probably already familiar, the management of a company cannot record a sales transaction in their book if the transaction itself did not occur. For example, a sale transaction. The management cannot increase their cash or accounts receivable and reduce their inventory if the sale itself did not occur. They can record that only if the transaction have occurred and finished. So it is more about transaction and the events. On the other hand, we can see that the first assertion in the assertions about account balances is existence, and the definition is assets, liabilities, and equity interests exist. So it is more about the items in the financial statement. It is about whether or not the recorded items in the financial statements really does exist. For example, like I mentioned earlier, Astra International wrote in their balance sheet that they have cash amounting to 61 trillion rupiah. Of course, they cannot wrote that number and record that number if they does not have they they don't have that cash. So they can only record that number only if the cash belong to them and available at their disposal. So yeah, I hope my explanation can make you better understand about the differences between assertions about classes of transactions and events and assertions about account balances. Now we are getting into the first quiz. So for the first statement, recorded accounts receivable are not collateral for a debt and there are no other restrictions. We can see that the statement provided is very specific to an item, an asset that is accounts receivable. For this reason, the correct type of management assertion is account balances. The management assertion itself is rights and obligations because it is related to whether or not the accounts receivable are fully owned by the client or there are any restrictions being put by the creditors, for example. It questions whether or not the accounts receivable are owned fully by the company or is there any restrictions being put by the bank or lender or something. So yeah, that's for the first question. And now for the second statement, all sales transactions have been recorded. As you can see, the statement is very related to transaction. It mentioned all sales transactions in the statement. For this reason, it is considered as assertion about classes of transactions. The management assertion itself is completeness because it is related to whether or not the transaction have been recorded by the client. Now for the third statement, accounts receivable are properly classified as trade receivable and other receivable in the financial statements and are clearly described. This statement is about a component in the financial statement, and whether or not they have been properly classified, described, and disclosed. So for this reason, the correct type of management assertion is presentation and disclosure. The correct management assertion is classification because it is related to the classification of accounts receivable. For the fourth statement, all sales transactions have been recorded in the correct and proper period. Now, like I mentioned earlier, this statement said about transactions. So the correct type of management assertion is classes of transaction. And the correct management assertion is cut off because the statement is related to the proper period of recording that the company performed. So yeah, it is cut off. The management assertion is cut off. For the fifth statement, sales transactions have been recorded in the proper account. Like the previous statements, this statement mentioned about transactions. So, of course, as usual, the correct type of management assertion is classes of transaction. And the management assertion is related to classification because the statement talked about whether or not the transaction have been recorded in the proper account. For statement number six, all mandatory disclosures regarding sales and accounts receivable have been made. So all statements that mentioned about disclosure, the correct type of management assertion will always be presentation on disclosure. It is the correct type of management assertion. And the management assertion itself is completeness because the statement talked about whether or not the mandatory disclosures have been made. For the seventh statement, all sales transactions have been recorded in correct amount. Now, yeah, like the previous few questions, this statement talked about transactions, so the correct type of management assertion is classes of transactions, and the management assertion itself is accuracy because the statement talked about whether or not the transaction have been corrected in the correct amount. So yeah, the correct management assertion is accuracy. For the eighth statement, accounts receivable recorded really exists. Now, this statement really talked about specific item in the financial statement that is an asset. Accounts receivable is an asset. So the correct type of management assertion is account balances. And the correct management assertion is existence because it talks about whether or not the item in the financial statement really does exist. For the ninth question statement, disclosures related to sales and accounts receivables are those related to the entity. Yeah, like I said for the previous statement, anything that mentioned about disclosures, the correct type of management assertion is the presentation and disclosure one. So yeah, it is the correct type of management assertion, and the correct management assertion is occurrence and rights and obligation. For the tenth statement, accounts receivable have been calculated and recorded appropriately based on the best estimate of expected cash received from customers. The Because this statement talked about a very specific item in the financial statement, asset as well, accounts receivable. The correct type of management assertion is account balances, and the correct management assertion itself is accuracy, valuation, and allocation because it talked about whether or not the item in the financial statement have been calculated and recorded appropriately based on the best estimate of expected cash received from customer. It is about the calculation. So the correct management assertion is about accuracy. Okay, now we are moving on to the second topic. We will be talking about audit evidence. Now, let's recall the first session we were being taught by Mrs. Arizona. She mentioned that auditing in hindsight is a process done by auditor to verify and give assurance that information provided by the management of a company are matched with the reality that has happened. So the question is, how can an auditor know whether or not the information provided by the management really match the events that are happening that has happened in real life? The way auditor can match between the two information is by obtaining evidence. So it is correct to say that the foundation of any audit is the evidence obtained and evaluated by the auditor. Evidence itself is the obtaining evidence itself is the core process of auditing. So yeah, the auditor must also have the knowledge and skill to accumulate sufficient appropriate evidence on every audit to meet the standards of the profession. Now, there are several evidence that are usually obtained by auditors. They are first of all, I'm not going to mention them very much in detail because you can find them in books. But I'm going to explain uh, each evidence based on my knowledge and my experience so that you guys can have better understanding. The first one is physical examination. It is basically examination of the physical form of an asset, and it is usually performed for fixed assets such as buildings and cars. The second one is confirmation. They are letters sent to outside parties, such as banks and customers, to verify the existence or the balance of an asset or liability. For example, confirmation sent to one of the bank in Indonesia, Bank Mandiri, to confirm about the balance and the maturity date of the client's liability. The third one is inspection. It is basically examination performed on documents. So any examinations that involving documents, they called inspection. They are relatively similar to physical examination, but the difference between the two is that physical examination usually performed on fixed asset like buildings and cars. Meanwhile, the inspection are usually performed on the documents, for example, like invoices, minutes of meetings, and many other documents. The fourth one is analytical procedures. They are evaluations of financial informations through analysis of plausible relationships among both financial and non-financial data. For example, when an economic downturn happened, such as when COVID-19 pandemic hit Indonesia, an auditor expects that the sales performance of a real estate company to decline because, of course, during that time, no one will buy any property from property company, from real estate company. So, yeah, auditor expected that the sales performance of those companies to decline. To verify this, the auditor compare the sales figure for current year and prior year. The auditor need to know whether or not his or her expectations are really matched with the actual information provided by the management of the company. The next one is inquiry of the client. It is basically obtaining of written or oral information from the client in response to questions from the auditor. The next one is recalculation. It is pretty straightforward. It involves rechecking a sample of calculations made by the client. And the next one is re-performance. It is auditors' independent tests of client accounting procedures or control that were originally done as part of the entity's accounting and internal control system. For example, an auditor that wants to check the company's accounting system. So he tested out the accounting system of a retail company, for example, such as Target, by trying to purchase an item and see how the purchase that he did affect the sales journal and inventory level. The last one is observation. It is basically looking at process or procedures being performed by others, and some of you might get confused about observation and physical examination and inspection, but unlike physical examination and inspection, where both of them are looking at tangible things such as physical assets and documents, observation is more like looking at activities instead, and what was being observed has no physical form. For example, like an auditor observing how employees at Nestle perform their regular inventory calculation in their warehouse. So yeah, the auditor just sit there and observe the method that the employees are using. So yeah, it is different from physical examination and inspection of documents. Now we get into the second quiz, starting from number 1 to 5. The first question is, choices about audit evidence are influenced by all of the following except. Now the first choice is the auditor's understanding of the business and industry. This one influenced the audit evidence because the more complex the industry that the client operate, there will be more evidence needed to perform the audit. For example, like in banking industry, there will be more audit. There will be more audit evidence obtained in banks, for example, in comparison to the audit evidence uh, being obtained for a company that operate their business in the retail industry. So yeah, the first choice is out of the question. Now for the second choice, comparisons of the auditor's expectations of the financial statements with the client's books and records. This is a little bit related to the analytical procedure. So this one affect the audit evidence that the auditor obtained because of course the auditor's expectation of the financial statement will affect the audit evidence that he or she obtained for the whole audit process. Now, for the third option, decisions about immaterial risk factors. This one does not affect choices about audit evidence, so this one is the correct answer. For the last option, decisions about assertions that are material to the financial statements. Of course, this one will affect the choices about audit evidence because each assertion may require different evidence to obtain. Now we get into the second question. Accounting records generally include the first option is general ledgers. Of course, accounting records have general ledgers, so this one is the correct answer. But let's get into the other option. Minutes of meetings. Accounting records does not have this because it does not minutes of meetings are not relevant to the accounting records. So they are not included in the accounting records. The third option is internal control manuals. This one are also not relevant to the accounting record. So the management does not put them in the accounting records. So this choice is out of the question. And the analysis reports as well. Analysis reports are reports that is provided by investment analyst. So it's not internally provided by the company. It is an externally provided reports. So they are not relevant to accounting records. So yeah, the correct answer is general ledgers. The third question is when planning the audit, the auditor must make the following important decisions except the first one is nature of tests to be performed. This one is important decision because the first two option actually also with timing of tests to be performed is important because in the engagement letter that it has been agreed upon by the management and the auditor, they are included the nature of tests to be performed and timing of the test to be performed. So yeah, the first two options are out of the question. They are required and they are included as an important decision. Now, the third option is audit staff assignment. This one can be done later on in the audit process. So this one does not considered as the important decision in the planning. So yeah, the option number three is the correct answer. Extent of the test to be performed is also an important decision and are included in the engagement letter between the auditor and the management of the company. Now, the fourth question is which of the following that has the least reliable audit evidence? Purchase invoices. Now, if you guys don't know, purchase invoices are invoices that are documents basically that are provided by the third party outside of the entity being audited. So, this one, the purchase invoices are pretty reliable and it is the option is out of the question. And the second option, bank statements. Bank statements are also provided by banks that the company is that the company is working with. So it is a third party. So bank statements are considered reliable audit evidence because they are produced by outside entity. Now, the client's working paper calculations, they themselves does not considered are not considered as audit evidence. So this one is not correct because client's working paper calculation is basically just working paper calculation and it's not audit evidence by itself. And the last option is sales invoice signed by sales manager. This one is least reliable because they are provided internally by the management, the sales manager. So yeah, there are many incentives for the sales manager to fabricate them. So yeah, this one is the least reliable audit evidence. Now we are on to the last question in this slide, number 5. Which of the following presumptions is correct about the reliability of the audit evidence? Now, the first option is to be reliable, audit evidence should address the audit objective. This one is not correct because to be reliable, usually the audit evidence needs to be provided by an outside entity. So, yeah, the first option is not really relevant and pretty incorrect. So, yeah, the option is out of the question. The second option is reliability of audit evidence refers to the amount of corroborative evidence obtained. No, not really. Once again, the reliability of an audit evidence is usually related to whether or not the evidence itself is provided by internal or external entity. So yeah, this option is out of the question as well. Now, on to the third option. Effective internal control provides more assurance about the reliability of audit evidence. Yes, this one is correct because the more effective the internal control being implemented in an entity, the client, uh, there are less space for the management to fabricate the documents, for example. So yeah, the evidence being obtained by the auditor will be more reliable and it provides more assurance about the reliability of the auditor's evidence. So the third option is the correct answer. Now the last option is information obtained indirectly from outside sources is the most reliable audit evidence. This one is kind of true, but the C is the more correct answer because sometimes the internally provided uh, evidence can be reliable as well. For example, like uh, company of course have their own system, accounting system, and when they have proper and good internal control implemented, the internally provided evidence can be reliable as well. So yeah, the third option is the more correct answer. Okay, now we are moving to the question number 6 to 10. The question number 6 is which of the following is not a primary purpose of audit documentation? We're on to the first option to coordinate the audit. It is correct, and it is one of the primary purpose of audit documentation because auditor usually use them to check on the audit process to know where they at in terms of checkpoint of the audit process. So yeah, they can be used to coordinate the audit. And the second option is to assist in the preparation of the audit report. Yes, audit report requires proper documentation. So yeah, audit documentation in itself, uh, of course, they assist in the preparation of the audit report. Now we are on to the third option, the provided evidence to provide evidence of the audit work performed. So yeah, they are also can be used as a source of evidence that the audit work has been performed. It will be used as a proof that the auditor has actually have done the audit procedure. So yeah, it can be used to provide evidence of the audit work being performed. And The last option, to support the financial statements. Now you must understand that auditors are not mandated to support the financial statements issued by their clients. So yeah, this one is the correct answer because it is not the purpose of audit documentation. Audit documentation uh, are not used to support the financial statements of the client entity. Now we are on to this question number 7. Which of the following would not be considered an analytical procedure? Now, let's throw back to previous few slides. The analytical procedure is basically an auditor obtaining information, uh, financial information, and compare it to non-financial information. For example, like auditor have an expectation about the performance of a company, and then he measured the its actual performance, and then compare the actual information and his or her expectations. So let's see the first option. Calculate the gross profit ratio and compare it to the industry figures. This one is considered as analytical procedure because industry figure is non-financial information and the gross profit ratio is financial information. So yeah, it is considered as analytical procedure because yeah, the auditor is comparing the information that is provided by the company internally and compare it to outside information. The second option is compare current year's working capital to prior years. This one is also considered as analytical procedure because, like I mentioned earlier, auditor for each year have an expectation about the performance of a company, and so he or she compare the actual performance in the current year to the actual performance from prior year. So yeah, it is considered as analytical procedure. Now, the third option is compare the per unit price on a sales invoice to the master price list. This one is not an analytical procedure and more like inspection because the comparison of sales invoice, the auditor examines the document like sales invoice is a document. So in this instance, the auditor is examining a document and compare it to the master price list. So this option is more on the inspection audit evidence and not analytical procedure. So option 3 is the correct answer. Now let's take a look at the fourth option. So the fourth option is divide sales commissions by sales and compare the result to the established commission rate. This one is also analytical procedure because there is comparison between uh, information that auditor have to work with. For example, like he has to divide sales commissions by sales and then do a comparison to an information that are provided by uh, party outside of the management that are providing the information of the financial statement. So yeah, the correct option is the third option. Now for question number 8, which of the following procedures consists of seeking information from knowledgeable persons, both financial and non-financial, throughout the entity or outside the entity? So this one got you guys, a lot of you guys have been wrong in this question. And yeah, it's pretty confusing at first, but we must take a look at this statement, both financial and non-financial. Now let's take a look at each of the options provided. The first option is inquiry. This one is the correct answer because inquiry is basically seeking information from knowledgeable person, both financial and non-financial, throughout the entity itself or outside the entity. So this one is the correct answer. And the second option is confirmation. This one is incorrect because confirmation is basically asking outside entity only by sending them letters, and the information that the auditors are asking is about financial information. So it is not about non-financial. It is confirmation only as about financial information. So yeah, it is incorrect. Now we're moving to the third option, reperformance. Of course, this is uh, obviously wrong, so I'm not going to go into details. And the fourth option is analytical procedure. This one is also incorrect because yeah, I already provide explanation about analytical procedure on the previous question, so it is obviously wrong. The correct answer for question number 8 is inquiry. Now, for question number 9, the subject of the auditing procedure inspecting is least likely to be. Now, inspecting, I already mentioned earlier that some of you guys might confuse about physical examination, observation, and inspections. So, yeah, this is the question that you guys should watch out, especially if they appear in your midterm exam. Documents, like I mentioned earlier, documents are considered inspecting. So inspecting is considered as obtaining evidence from the examination of documents. So documents are the most likely source of evidence that is being obtained in the inspecting procedure. Physical assets. Now, physical assets, obviously, it is considered as physical examination, but inspecting can phys- can also included in the physical assets examination. Physical asset examination is also considered as inspecting because yeah, inspecting a physical asset does not uh, make auditor provide or perform a detailed examination on the for example like cars and buildings, but still it is a part of inspecting. So it's not as likely as documents, but it's still there. Like you get my point. I hope. Accounting records, of course, this one is document. So this one is also in the same place as documents as the most likely object that auditor will be inspecting. So yeah, it is considered inspecting. Now, the last option is personnel. This one is very different from the previous three options because the previous three questions have physical form. They are documents, they are physical assets, and they are accounting records, is which also are documents. So personnel, it has no physical form, and we can only observe it, we can only see its behavior and not examine it very clearly, not as clearly as documents and physical assets or accounting records. So yeah, the correct answer is personnel because personnel is more on the observation type of audit evidence. I get it is a little bit confusing, and I also have a hard time in explaining the difference between the three, but I hope you get what I'm saying. Like inspecting and physical examination are almost the same, but usually they are different in what was being examined. Physical examination is more so on the physical fixed asset like building and cars. Inspecting is more like on the documents or paperwork, minutes of meetings, etc. And both of them are almost similar because they have physical form. Now, observation, on the other hand, is very much different because they have no physical form and can only be observed using eyes. So yeah, I hope you guys can understand that. Now, for the last question is which of the following audit procedures that are the most costly performed by an auditor? Inspection and physical examination is the first option. Inspection by itself is not expensive because in doing the audit, of course, the auditor must go to the client's office and there are no additional charges or expense that auditors incurred when they do some inspection on some documents. So it is not expensive per se. So this option is out of the question. Now, the option number two, physical examination and confirmation. Physical examination require the auditor to be in the place of the uh, physical place of the fixed assets. For example, like Unilever, they have buildings in Surabaya. On the other hand, their head building is in Jakarta. So of course, the auditor have to travel to go to Surabaya and incur more expenses. So yeah, this one is pretty expensive because yeah, like I said, to the auditors have to travel to get to the physical location of the fixed asset. And confirmation is both expensive in time and in money because to send letters to outside parties, you need to incur money and incur more expense. And not only that, auditor must also wait for the confirmation to get returned. And sometimes the confirmation is not returned on while the auditor have waited for so long, and in the end the confirmation is not returned. So it is very expensive both in time and in money. So yeah, the correct option is the second option. Now for the third option, yes, confirmation is expensive. I already explained it. And inspection is not expensive, and I already explained it in the first option. Now the last one, observation and physical examination. Observation by itself is not expensive because the auditor just sit there. For example, like an auditor observing how the employees count their inventory. It's not really expensive because the auditor just sit there. And on the other hand, physical examination, like I mentioned, like I already explained earlier, is pretty expensive because yeah, the auditor have to travel to get to the physical location of the fixed assets. That's it for the video. I hope you will find this video helpful, and I hope that this video will help you in your preparations for the upcoming exams. I'm sorry for any explanation that are not clear and might confuse you further, but I hope that this video will increase your understanding and help you remember the basic concept of auditing. So yeah, thank you very much and take care, guys.